Cost of debt is of three types: irredeemable debt, redeemable debt, and convertible debt. Let's see what is meant by irredeemable debt. Irredeemable debt. In this debt, issuer is not liable to repay with any specific date. It is also known as perpetual debenture. For example, if a company has borrowed 10 lakhs rupees from a debenture holder, the company has to return to the debenture holder, but it's not going to return as it is a irredeemable debt. It's going to pay interest for that. It's not going to return the borrowed money, but it's going to pay interest for the borrowed money. That is called as irredeemable debt. Now let's see the formula to calculate cost of irredeemable debt. It is interest after tax divided by net proceeds. Interest after tax is equal to interest into 1 minus tax rate. இப்போ கம்பெனியோட ஃபேஸ் வேல்யூ 100, அதோட இன்ட்ரெஸ்ட் வேல்யூ வந்து 8% அப்படின்னா 100 இன்ட்டு 8% 8 ருபீஸ். 8 ருபீஸ் மட்டும் இன்ட்ரெஸ்ட்டாக பே பண்ணால் போதும். ஆனால் இப்போது ஆஃப்டர் டேக்ஸ், இன்ட்ரெஸ்ட் ஆஃப்டர் டேக்ஸ் அப்படின்றதுனால அந்த 8 ருபீஸ் நம்ம அப்படியே வச்சுக்கலாம். இன்ட்ரெஸ்ட் இன்ட்டு 1 மைனஸ் டேக்ஸ் ரேட். இப்போ டேக்ஸ் ரேட் வந்து 25% அப்படின்னா 1 மைனஸ் 25% 0.75 இன்ட்டு இன்ட்ரெஸ்டோட வேல்யூ 8. 0.75 இன்ட்டு 8 வந்து 6 ருபீஸ். ஆக்சுவல் இன்ட்ரெஸ்ட்டோட வேல்யூ 8 ருபீஸ். நம்ம டேக்ஸையும் டிடக்ட் பண்ணி 6 ருபீஸாக பே பண்ணுறோம் டிபென்ச்சர் ஹோல்டருக்கு. இன்ட்ரெஸ்ட்டாக டேக்ஸையும் ரெடியூஸ் பண்ணுறதுனால நம்மளுக்கு கம்பெனிக்கு ஒரு ப்ராஃபிட் இருக்குது. ஸோ தட் we are using interest into 1 minus tax rate. Net proceeds means the amount collected by the company. Amount the seller receives after deducting all the costs and expenses is called the net proceeds. Net proceeds we have, for calculating net proceeds we have two formulas. We should select the formula based on the information given in the question. If the question has current market price, we can directly choose current market price as net proceeds. If the question has issue price and flotation cost, then the formula we should use is net proceeds is equal to issue price minus flotation cost. Now let's see what is meant by redeemable debt. It is straight opposite to irredeemable debt. Here, debt which is repayable back to the lender within specific period, that is called redeemable debt. Cost of redeemable debt is equal to interest after tax plus average other costs divided by average funds employed. Now let's again take the same example that the company has borrowed 10 lakhs from a debenture holder. It has to return 10 lakhs within a specific period, that is like 10 years or 7 years. It has to return, and it's going to return those 10 collected 10 lakhs from the debenture holder to debenture holder again within 10 years. In the meanwhile, in the 10 years gap, company is going to pay interest. The company is going to pay interest only for those specific period. And the end of the 10th year, it's going to return the borrowed money to the debenture holder. Now let's see how to calculate cost of redeemable debt using YTM method, that is yield to maturity method. The first column mentions the year. The beginning year is considered to be year 0. Then the balance life given in the question is considered to be the second year. Next to the year column, cash flows are to be mentioned. Once the cash flows are written, the present value factor is calculated based on some guess rates. Now the present value factor is multiplied with the cash flow and we get discounted cash flow. By adding this discounted cash flow, we get NPV, that is the net present value. Now the computed net present value is applied in the formula and the cost of redeemable debt is computed. Let's see what is convertible debt. As the name mentions, it can be converted into equity shares after a specific period. It is a long-term debt. It is computed using the same formula as cost of redeemable debt. The only change is in the computation of redeemable value. In the redeemable debt, the redeemable value is assumed to be 100, but here it is computed using a formula, that is conversion value of equity is equal to conversion ratio into expected market per share.